Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello all. Welcome to this week's edition of Top Stock Picks. I'm Ethan Feller, stock strategist here at SEI Investment Research. And today, my colleague Dave Bartosiak and I are going to share two compelling stock picks for you to keep your eye on. My pick for the week is The Progressive, ticker PGR. The Progressive is a leading insurance company, primarily known for its auto insurance offerings, but also provides home, commercial, and specialty insurance products. The company has a reputation for innovation, particularly in usage-based insurance and pricing algorithms, which allow it to offer competitive rates while managing risks effectively. Progressive's strong market position is supported by its direct consumer sales model, effective advertising, and partnership with independent agents. The history of consistent premium growth and profitability, PGR has outperformed many of its peers in the insurance industry, making it a top choice for investors seeking stability and growth in the financial sector. Progressive is the second largest insurance company in the industry, as measured by premiums, with 15.3% market share. This is second only to State Farm, which has an 18.3% market share. As we can see, most importantly, the Progressive has a Zacks Rank 1 strong buy rating. Also, I want to note, insurance companies, maybe they don't seem like the most exciting companies or, trending sort of stocks to buy, but it's an extremely strong and powerful business model. They have very little capital expenditures. And, as you'll see, the Progressive is growing extremely fast still, even as a mature company. And it has, like I said, just a powerful business model. As you can see, analysts, based on the Zacks earnings ESP, we're expecting the Progressive to beat earnings estimates at the next quarter by 1.43%. And we can also see that at the most recent quarterly earnings that passed, the Progressive beat earnings by 5.29%. So company continues to show strong results. Also, something I really want to note is that the Progressive trades at an extremely reasonable valuation. Today, it's trading at a forward earnings multiple of just 18.5 times. And what makes it especially compelling is that it has earnings per share growth forecasts over the next 3 to 5 years of 27.5%. So earnings are expected to grow very rapidly. And with earnings growing that fast and forward earnings multiple of just 18.5, it means that the company has a PEG ratio of 0.67. The PEG ratio is a metric that discounts growth for earnings. So if the PEG ratio is below 1, based on the metric, it would mean that the company is trading at a discount. So 0.67 is pretty low. So you get a lot of growth for a very reasonable valuation with the Progressive. So as we noted, it has a Zacks Rank 1 rating. So let's take a look at the earnings revisions estimate. In this chart, we can see we have the stock price, and these dotted lines are the earnings revisions trend. You can see the stock price has gone on a pretty strong rally over the last year and a half, 2 years or so, starting in mid-2023. Since then, the stock has more than doubled from $120 to $240 today. And the earnings revisions trend has been strongly trending higher over that period as well. But insurance prices have gone up. The demand for insurance has remained the same. And so the company's profit margins have increased. Pretty simple, pretty straightforward. And we can see that the earnings revisions trend continued to trend higher. If we look at the current quarter earnings revisions, we can see there have been some downgrades just for the current quarter, though. And it's not significant. You can see current quarter earnings estimates have been lowered by just 0.64%. And then all the rest of the future earnings forecasts and revisions are higher, almost unanimously, just 2 revisions lower in the next quarter. And then all the rest are revisions higher. So the next quarter is expected earnings have been revised higher by 5%. This year's earnings revisions have been revised higher by 6.7%. And next year's earnings have been revised higher by 6.6%. So those are all nice margins. And they've just been continually trending higher. So also notable, Progressive has sales growth forecasted at 20.5% this year, which is significantly higher than the industry, which is just 4.3%, and the S&P 500, which is also just 4.4%. It has net margins of 11.3%, again, higher than the industry and just below the S&P 500. Return on equity is very high at 35%. And it just has generally strong metrics. You can see it's been a desirable stock. It's up 53% year to date. Especially notable in the Progressive stock is the technical setup. If you followed any of my other content earlier this year, I've been highlighting Progressive all year, and the chart continues to build out very interesting chart patterns. We can see here that there was a big consolidation, and then the stock broke out in late summer. We have a similar setup building here. Right now, the price action is trading just at the bottom of a range. And I think this is actually a really interesting spot to look at the stock. So long as it holds above this, let's just say $240 level, it should get back to the top of this range, and I wouldn't be surprised if it broke out again. And what makes it more compelling as a stock is that it has just such a reasonable valuation. So there's much less risk of it, just flushing lower, or shaking out traders, because even though it's gone up so much year to date, it's still at a very reasonable valuation. So I wouldn't be surprised to see this level of support hold. We retest this upper level of resistance and then break out. That's my top pick for the week. Let's see what Dave has to offer.
All right, Ethan. Well, thanks for that. I've got my top stock pick of the week. It is Zacks rank number one, a strong buy, SEI Investments, ticker SEIC. Like I said, Zacks rank number one, strong buy. It's in the financial investment management industry, which ranks in the top 9% of our Zacks industry rank. A couple things just to look at. It's coming off a decent earnings surprise, a nice beat to the upside, 11.2%. And already there's a positive earnings ESP heading into next quarter, but really it's all about the previous quarter and what happened. Taking a look at these sales numbers, you see the growth. Current year revenue growth, 10.6%. Next year, 6.74. Translated over the EPS side of things, that's almost 27% EPS growth this year. Next year, 10.24% EPS growth. So those are decent growth numbers there. That's what you like to see. Following that last earnings surprise, we have 6 analysts up in the ante for the current year and 6 analysts up in the ante for next year. What's that done to our Zacks consensus estimate? It's gone from 418 to 438 for the current year, from 451 all the way up to 483 for next year. So that's really a good sign. And I want to just pop in here real briefly. This is our price consensus and EPS surprise chart, my favorite chart on Zacks.com. And you could see after this last disappointing earnings report where the stock missed, you got beats 1, 2, 3, 4, 5, 6 earnings beats in a row. But also what I want to point out is that this earnings trough here, the end of 2024, and then ticking up in a positive direction, that really helped the stock price run up along with it as well. So with the market doing well and this company obviously doing better when markets go up, since they're in investment management, I think it's a decent conclusion you can draw that the stock could continue the upside as long as the market does well, as long as those earnings numbers continue to come in. So there you have it for our top stock pick of the week. For Ethan and everybody here at Zacks.com, I want to say thank you so much for checking us out. And don't forget to go to Zacks.com/promo for this week's awesome deal. Thank you guys so much for checking us out, and we'll see you next week.